Hello everyone and welcome to yet another video from Life Simplified. India's biggest festival Diwali is just around the corner and it makes sense to talk about whether you should buy gold at all this Dhanteras to make an investment or should you just settle for some non-precious metal this Diwali. But before we move ahead to answer that question which is rattling your brain, let's have a look at a hypothetical situation. Let's assume you are the pro-investment, financially wise guy in your family, and knowing that the prices of gold have hit a lifetime high, you decide to liquidate that gold jewelry which has been lying in your home under your asset column for a very long time. What this would cause at your home is certainly not a logical argument, but a situation very similar to this. Well, it might not be that intense, but you got my point. While this episode might leave you completely frustrated, you should be wise enough to understand that gold jewelry in Indian households are more of an emotional anchor rather than an active investment tool. हर हिंदुस्तानी घर में ये कहा जाता है, ये सोना बुरे वक्त में काम आएगा. How Bollywoodish, right? Does that mean that the story of gold as an investment tool is over? Well, to answer that question, let's go back in time. India faced huge economic challenge in the year 1991, and this was the black period of India's foreign exchange crisis. Due to this, India's central bank or RBI had to pledge 67 tons of gold with various international agencies, the Bank of England being the prominent one. And this was done to raise funds to meet India's import requirements. Since then, Reserve Bank of India has accumulated more than 650 tons of gold to ensure that we sail through any other crisis situation ever. And this reserve is world's third largest reserve. So now you know two things. One, that the Indian household and RBI both tend to accumulate gold. And second, both of them do it for the very same reason. That is to sail through crisis situation and hedge against such situations. After establishing the indispensability of gold in your portfolio, let's delve deeper into following four aspects to understand the gold ecosystem a little better. The first is the historical trend of gold prices. The second is the current trend of gold prices with respect to demand. The third is the golden paradox of gold prices and its demand in the modern times. And fourth is the various options to invest in gold. Let's look at the first option to go ahead. So let's have a look at historical trends of gold prices with respect to major crises in the world. During every major world crisis, gold prices have seen a definitive upswing. During the Great Depression of 1929, the gold prices saw an increase by greater than 50%. Right after World War II, gold prices saw an increase of more than 100%. And in recent past, during the Asian economic crisis, gold prices saw an upswing of greater than 100% within a short span of 2 years. This is in contrast to the relative peaceful times of 80s and 90s, where the gold prices have remained relatively stable. This points to the tendency of individuals as well as institutions to park their money in the safety net of gold in troubled times, whereas in other investment option in more peaceful times. With this, we come to our second aspect of analysis, which is the current trend of gold prices. COVID-19 pandemic has created a unique situation in the financial markets world over. First, there is a huge economic slowdown. To counter this slowdown, the governments world over have been pushed to release $19 trillion as economic incentives. These economic incentives have created unparalleled liquidity in the market with little avenues to invest in. Gold being a hedge against uncertainty, the prices of gold have jumped from 40,000 rupees in 2019 to 53,000 rupees per 10 gram in September 2020. Does this really mean that people are rushing on to buy gold jewelry and ornament? Not really. Let's answer that question in the upcoming section. According to the World Gold Council, jewelry demand is down by almost 50% in the first half of 2020. This is at the same time when the prices of gold are at an all-time high. What can explain this inconsistency? One way to explain this inconsistency is the inflow of fund in gold ETF in July 2020 is double of that of June 2020. And also the successful implementation of SGB or sovereign gold bond by Government of India indicates that paper gold is increasing its share in investment, while jewelry is increasingly being recognized as an expenditure rather than an investment. This brings us to the most important aspect of today's discussion, which is various tools of investing in gold along with their advantages and disadvantages. Any investment, including gold, can be assessed on the following 5 criteria. First is ease of buying. Second, cost of acquisition. Third, associated taxation. Fourth, cost and ease of storage. Fifth, liquidity and return related to it. Now let's evaluate gold investment basis above 5 criteria. Let's begin with jewelry and ornament. The ease of buying jewelry is self-explanatory. However, the real challenge in considering jewelry as an investment option is the inbuilt loading charges which comes in the form of making cost. Now this cost can although vary from retailer to retailer. They are as high as 15 to 25%, and this is apart from the GST levied on retail jewelry. While taxation from sale of gold jewelry is taxed as capital gains. This is apart from one must invest in locker charges to ensure safekeeping of their jewelry. So now that we have seen jewelry as an option, let's look at the other investment option, and the next one in line is gold bars and coins. While considering gold bars and coins, the 4 criteria to be considered, which is ease of buying, ease of storage, liquidity and taxation, remains same as jewelry. The one area where one can save is the associated cost of making charges, which as we said earlier varies from 15 to 25%. All the rest of the factors remain same while purchasing gold bars or coins. The next available investment option in gold, which we will talk about, is digital gold. Digital gold is the more convenient way to purchase gold, as the same can be purchased from online platforms like Paytm and Amazon Pay. What makes it really attractive for small retail investors is that the minimum investment amount is as small as 1 rupee. However, one must note at the time of delivery of the gold, the minimum investment value should be at least 0.5 to 1 gram depending on the platform through which one has invested. The first form of paper gold is gold ETF. It is one of the easiest mode of investment in gold, with no worry on the purity as it derives its value from the underlying metal. What also makes it extremely convenient is that one can invest in units as small as 1 gram in gold ETFs. While taxation treatment of selling gold ETFs remains similar to physical gold, it is extremely easy to save ETFs in demat accounts as digital form. The only minor caveat in purchasing gold ETF is the brokerage and the management fee, which any which ways is capped as low as 1% of the total purchase. It is also one of the most liquid form of gold investment, as it can be traded on exchange comfortably sitting at home. And now we come to the latest avenue of investing in gold, which is SGB or sovereign gold bond. These are government securities in the form of bond issued by Reserve Bank of India on behalf of Government of India. There are 7 such series released by Reserve Bank of India till date, and these are an excellent investment tool for investing in gold. The price of SGB is as per notification released by RBI. The biggest advantage of SGB is 2.5% simple interest paid annually. There is a discount of ₹50 for SGB subscribed online. It is also the most tax efficient mode of investment in gold, as redemption done after 8 years of maturity is completely tax free. The interest paid on SGB, however, attracts income tax, and which is not deducted at source, and hence the investor is liable to disclose the same. The option of trading SGB on exchanges and early redemption option after 5 years of purchase, both these exit options will attract capital gain taxes. However, in case of emergency, one must note that SGB can be used as collateral to apply for loan. Overall, SGB is one of the best choices of investing in gold. In case you are still confused about real definition of an asset and liability, Do watch my previous video on book summary of Rich Dad, Poor Dad. The video link of same can be found in description below. So to conclude, the idea of gold investment as a part of portfolio diversification strategy is indisputable. One must invest 10 to 15% of their saving in gold investment options. This will give your portfolio the much needed stability at the time of crisis. Hope through this video you are clear on difference between spending and investing in gold. While buying jewelry due to its inbuilt efficiency should be considered as an expense, buying paper gold should be considered as an investment, both in the form of SGB or ETF. Do check out the summary of this discussion in the Excel sheet attached in the description box. Thank you. Keep watching Life Simplified.